Is the state pension taxable? The short answer is yes, but how much tax you pay and how it's collected is a bit more complicated. In this video, we'll look at some examples to explain how tax on the state pension works. The first thing to remember is that tax isn't taken off the state pension before you receive it, but that doesn't necessarily mean you get to keep all of it. Understanding whether you'll have tax to pay on your state pension and how that tax might be collected can help you understand whether you need to budget for any later tax bills. Most people in the United Kingdom are entitled to a tax-free personal allowance, which means that no tax is payable on income up to a certain amount. As we're recording this in 2025, you can receive up to £12,570 of income without having to pay tax. If your total income is more than the tax-free allowance, the excess above that amount becomes taxable. The tax-free allowance hasn't changed since 2021 and is expected to remain at £12,570 until April 2028. During that time, the state pension has increased every year, which means more pensioners are finding themselves paying tax as their income has gone above the tax-free allowance. People who have other income as well as their state pension, such as private pensions or income from investments, will quite easily see their taxable income tip over the tax-free allowance, meaning they have to pay tax. But in some cases, this can even be true for pensioners whose only source of income is the state pension. Let's look at how tax is collected on the state pension received by 4 individuals: Alice, Bilal, Charlie and Derek. Alice reached state pension age in 2020. She receives a full state pension, that's £230.25 per week at the time of recording, which is her only source of income. Worked out over a whole tax year, her total income is £11,973. Because that's less than the £12,570 tax-free allowance, Alice has no tax to pay. Bilal was entitled to a full state pension from April 2022, but chose to defer it for 2 years because he was still working. Now he's retired, the state pension is his only source of income. Because Bilal deferred his state pension, he gets more than the normal weekly rate. His state pension for this tax year is £13,355. Bilal's state pension is more than his tax-free allowance, so he'll have to pay tax on the amount which exceeds his tax-free allowance. That's £785 on which tax is payable. Remember, no tax is ever taken off the state pension before you receive it. So how does Bilal pay his tax? Well, the good news is he shouldn't need to do much himself. HMRC should send him a request to pay the tax due on that £785. This is called a simple assessment, and it should arrive after the tax year ends on 5th of April. HMRC normally send them out between July and November. All Bilal should need to do is check the figures are correct and remember to pay by the due date. We've made a video looking at how simple assessment works, so check the link in the description below to find out more. Charlie's state pension is £9,000 for the current year. She also receives a pension of £12,000 a year from Pension Pals, a workplace pension scheme set up by her old employer. Whilst both pensions individually are less than the amount Charlie can receive tax-free, once you add them together, they total more than her £12,570 tax-free allowance, so Charlie will have to pay some tax. Although tax isn't deducted from the state pension before it's paid, it is from private and employer pensions. The tax code used on Charlie's Pension Pals income should factor in the amount of state pension income she receives, allowing the right amount of tax to be collected. Let's look at how that works in practice. Charlie's tax code should start with a full tax-free allowance of £12,570. From this, the £9,000 she's expected to receive in state pension income will be deducted, to make sure Charlie pays the right amount of tax overall. That leaves £3,570 of tax-free allowance left to set against her Pension Pals income, so the remaining £8,430 of that pension will have tax deducted from it. Fortunately for Charlie, all this should be worked out between HMRC and Pension Pals, meaning all the tax she has to pay is collected from her workplace pension automatically. Whilst Charlie shouldn't have to report her income or remember to make any tax payments, she should still keep an eye on any changes in her tax code to make sure everything is being dealt with correctly. We've made another video on how to check and change your tax code, which might help if your circumstances are similar. You can find a link in the description below. Derek worked as a self-employed builder until he retired in 2020. He didn't pay into a pension scheme while he was working, choosing to invest in rental properties instead as a way to fund his retirement. He now receives £25,000 of rental income each year, as well as his state pension income of £10,000. Derek's total income is more than his tax-free allowance, and no tax is collected from either his rental income or his state pension income before he receives it. So he'll need to deal with paying tax to HMRC himself. Because Derek receives rental income, he has to complete a self-assessment tax return each year. When Derek fills in his tax return, he'll need to include his rental profits and his state pension income. HMRC will then calculate how much tax Derek has to pay on both sources of income combined. Derek will need to remember to pay the amount of tax owed to HMRC for each tax year once he has submitted his tax return. The examples we've looked at show a number of ways tax due on the state pension can be collected. Everyone's circumstances will be different in terms of how much state pension they receive and what other sources of income they might have. If you're not sure whether you owe tax on your state pension income and how it might be collected, there's lots of free information about tax on the state pension online. For instance, there's a service on gov.uk which can help you understand your position just by entering some basic details. We've put a link in the description below, along with some links to helpful free information on the website of the ATT sister organisation, the Low Incomes Tax Reform Group. If you want bespoke advice about tax on your state pension, you should talk to a qualified tax advisor. You can find an ATT member to help you out using our Find an ATT service. There's a link to that in the description as well.